And so I'm going to introduce our keynote speaker while he's getting set up. He is a fellow CCIM. So his name is Brian Bailey, and he is a subject matter expert in the Supervision, Regulation, and Credit Division of the Federal Reserve Bank of Atlanta. He's responsible for providing the leadership and monitoring emerging trends in commercial real estate. Brian has been actively involved as a lead wholesale reviewer in the annual stress test and capital review conducted on the national largest financial institutions. Brian has been requested to share his thoughts on commercial real estate at hundreds of venues, including the Federal Reserve System, multiple U.S. federal agencies, many universities such as Wharton School, industry conferences, and syndicated radio. Brian has extensive experience spanning both the public and private sectors with commercial real estate valuation, transaction development, and financial issues. Prior to joining the Federal Reserve Bank of Atlanta, he spent 15 years in various real estate industry positions. He was employed by the private equity firm Tavistock Group to oversee real estate finance and acquisitions, and before joining them, he was the director of real estate finance for Flagler Development Group, and that's Florida's largest commercial real estate developer. Brian's experience includes working for Ernst & Young, where he was an executive, and prior to that, he founded and operated an industrial development company that specialized in acquisition, development, and the refurbishment of industrial properties. And Brian got to start in commercial real estate as a local market appraiser. Awesome. And then after receiving a Bachelor's of Art in Business Administration from Mercer University, he earned an MBA degree with a concentration in real estate and finance from the University of Florida, and he also attained his CRE and CCIM designation. So please join me and welcome Brian Bailey. Thank you very much.
Well, I'm grateful for the opportunity to be here today. Amy, thank you for all of the work that you did in getting me here. We were able to put this together in 72 hours. and I have to say that my hair is not as good as Rajiv's. So from that standpoint, he has me beat. But hopefully my data and my thoughts are more thought-provoking. So we'll see. We'll see. Plus, it's not bad to hear from the Federal Reserve. So I want to talk today a little bit about inflation and the implications for commercial real estate. It is my view that, as all of you know, we are going through a change in the economy as we shift from a low-rate environment to one that is more normal, if I could borrow that. And certainly in a capital-intensive business like commercial real estate, that change will cause some challenges, but also some opportunities. And so in that respect, it's my view that I want to give you the information so that you can be better informed. I will walk through my presentation, and then I will, it'll be regulator on the hot seat, stump the regulator for Q&A. And let me tell you, I gave this presentation to 2,000 bankers yesterday. So we know that a lot of these topics are near and dear to the industry's heart right now. But just for transparency purposes, these are my thoughts and not necessarily those of my colleagues at the Atlanta Fed or the Board of Governors, though I've been at the Fed for almost 12 years. So I want to talk about the economy. I want to talk about finance and investment. I want to talk about commercial real estate issues, and I want to talk about the one. I'm hopeful that some of these are, impacting your business. So I'd like to talk first of all about the September economic projections that were issued by the FOMC. And the numbers are hard to see. My apologies. I'll give this presentation, and you're happy to disseminate it. It is all public information. But in essence, what we have here is we have the policymakers on the FOMC acknowledging that the slowing in growth is occurring. And so they have ratcheted down their projections in GDP from June to September. And we can see those projections flow through not only 2022, but also into 2023. These projections are made up of roughly 17 different opinions, and from that standpoint on the far right, we give you the range of those estimates, but you can see in some instances that there's a pretty wide range of potential growth in 2023 from negative 0.3% to 1.9%. On the unemployment front, right below that, we've seen a little bit of revision, but not a significant amount. I think that is a very good omen for commercial real estate, as jobs are, the bellwether, the foundation of commercial real estate activity. So from that standpoint, there has been a little bit of revision, but not significantly. We're talking, 4.4 as far as the unemployment rate in 2023. So gross domestic product, there have been lots of questions around where are we in the economy. We had a couple of quarters of negative growth earlier this year. A significant amount of that was driven due to trade issues associated with our partners who are having, some sizable challenges right now. Roughly 12% of our economy is affected by trade, and from this point, you can see that there were significant issues with exports in the first quarter. Now, we are seeing a pullback in investment in both non-residential, so commercial real estate, as well as residential structures right now. And that is a trend that has happened the last 2 quarters. So, what is showing up in the numbers, that the home building industry is having challenges. Their most significant challenge is they can't tell what interest rates are going to be in 6, 9, or 12 months, and that is gumming up the sales process because buyers cannot anticipate what their payment is going to be in the future. It's also having implications for commercial real estate. But in the last quarter, we saw, a growth of 2.6%. A lot of that driven by some of the trade issues that have been creating some headwinds. If we look at employment right now, a very, very robust picture. We're creating anywhere from 260,000 jobs a month up to 600,000 or 700,000 jobs a month over the last 18 months. So very, very strong picture. And again, I would offer the thoughts, how far can this go down if we have sizable job creation? I would argue that we need to create 100 to 125,000 jobs a month to keep up with population growth. So in essence, we're creating multiples of the needed amount to keep up with population growth every month. There are still some sectors that have deficits from pre-pandemic levels. Leisure and hospitality, a few others. Talking about unemployment, just to give you kind of perspective. It's hard to see, but there's a green line along the bottom. It's the lowest one, and that is U3. That is the number that is most widely quoted in the press, and essentially it's roughly 3.7% today. We are at 50-year lows. The only challenge is you're counted as employed if you work an hour a week, and I have yet to see any employer, let alone the Fed, sign off on that. I keep asking, that's what I put in the comment box every year. If you'd keep paying my salary, just let me work 1 hour a week. That's right. That goes in the comment box. I'm sure it's probably the first one thrown out. So we are at 50-year lows. We are back to the 50-year lows that we saw prior to the pandemic. If we look at the dark blue line, that is U6. It is a broader snapshot of unemployment. It captures folks who have part-time jobs, who want a full-time job. It captures folks who've given up, and from that standpoint, we're at roughly 7%. Back again to pre-pandemic lows, back to those 50-year lows, and you put it in context with 2008, when we were roughly at 17%, or at the spike of the pandemic when we were pushing 23, 24%. We certainly have been given time to get folks back to work, which has been, a very solid benefit. At the same point, the labor participation rate in orange there, we've seen the trend heading south over the last 10 years, 12 years worth of data here. But certainly during the pandemic, we had more folks retire. We had about 4 million folks retire. We also are seeing that there are roughly 2 million, 2.5 million folks that are reporting long-term effects of COVID as an inability to work. And so from that standpoint, we know that the labor force participation rate is down. Certainly we'd like to see some more folks come into the workforce, which would kind of negate some of the shortages that we're seeing and hearing about in businesses right now. At the same point, the hope is that may be driven by the health industry. It could also be driven by greater inflation, as we know that folks on fixed incomes don't traditionally fare terribly well during times of heightened inflation. And in that case, the 4 million folks who've retired, their skills probably aren't so stale that they couldn't return to the workforce and make a fairly, immediate contribution. What you all wanted me to talk about today is inflation. This is CPI, and it is a breakdown of the different segments. So I've got CPI, I've got core, which removes volatile food and energy. Next to it, I've got food and beverage, and the list goes on across. It's a heat map. So areas in blue saw significant year-over-year declines in price. Areas in red are seeing significant increases. Unfortunately today, the closer you get to the top of that heat map, you're into 2022, and from that standpoint, you see a significant amount of categories that have, red, that are seeing sizable year-over-year increases. Interestingly enough, right now, food and beverage up 10%, energy up significantly, but beginning to pare back as we've seen a little bit of relief at the pumps recently. The areas where it's sticky, takes a while to get going, and it'll take a while to come down. Housing, home ownership, rent, and we're seeing those gradually accelerating, and those are kind of toward the middle. Thoughts about the supply chain right now. If you go to the very far right, we've got pricing as far as new vehicles, and then the furthest column to the right is used vehicles. In some instances, we've seen used vehicle pricing up 40% year over year. That is beginning to taper off. It's my thought that tapering off, driven by improvements in the supply chain, it's also being driven by the early effects of policy. Other areas where we're seeing impacts of inflation right now is in the center. Think about lodging, where is one of the first places that the consumer could pare back discretionary income spending, and we are beginning to see some of that. So certainly the inflation is having implications for consumer spending. So this is our chairman, Chair Jay Powell, and I'd just like to kind of read off what he said here. This comes out of the FOMC briefing after the November meeting. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable pricing in the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. So my view is we're articulating exactly what we're doing right now. View is our goal is looking for inflation around 2%. We're beginning to see some signs that policy is having an impact. At the same point, we still have a ways to go. Earlier this week, our vice chair, Lael Brainard, was quoted in the Wall Street Journal saying, in essence, she's seeing some of those improvements, and that a time where we don't need to move at the accelerated pace that we're moving at may be approaching. Now, the job is not done, and Chair Powell is echoing, we will get the job done, but I think that we may begin to be approaching a time where we'll move out of these kind of larger than normal increases. I think that will allow this business to begin to forecast what interest rates are in the near term. And from that standpoint, folks may, hey, we're all excited about 3% money on our homes. 7% sounds, obviously higher, different, but at the same point, there are a number of you that remember a time when 7% was a good number, right? And from that standpoint, I'm glad to hear that you have a mentorship program, and some of that can be, and some of that knowledge can be shared. The other point I'd mention, I thought, I'm sorry, Stephanie? Yes. Okay, thank you. I thought she did a great job at articulating, the thoughts of CoStar on market conditions. One of the things I would say is that with Chair Powell here articulating a period of slower than normal growth, in a banking, as a bank supervisor, I see a lot of banks that say our borrowers showing up and they're telling us that rent growth is going to be 10% next year. We certainly have come through some of that, but I think the expectation that that's going to happen into the foreseeable future, is more remote. How about that? So multifamily occupancy right now, we know that the market inverted in 2015, and from that standpoint, the lower class, Class C, has a higher occupancy rate than Class A. Part of that driven because we're having a challenge as a nation building affordable product, not so much on the other end. And as Stephanie talked about, there is more of that product, in the pipeline today. So if we look at this, this represents demand in orange and then new supply in blue. We're building roughly at a rate of 420 to 440,000 units nationally right now. That's roughly, historical kind of norm is about 300,000. So we're building more units. We're kind of building them more on the high end. And I have questions about how deep that renter pool is. If you think about the numbers, right now college grads making probably 70,000 a year coming out of school, depending on the location. After tax, they make 55. And from that standpoint, they're going to spend $2,000 or $2,500 a month on rent. Sounds, pretty heavy on housing. So I think it's an area we have to watch. We know that that about 2/3 of the market have had some decline in occupancy rates over the last 12 months. Not a big change, but certainly beginning to see what Stephanie articulated. Talking about office. Certainly, my view, I'm bullish on the office. I think we're going to return to the office. At the same point, it will take us a little time to get there. There will be a new normal. Not sure that we'll be in the office 5 days a week, but there certainly are activities that are much, much more efficiently done in close proximity in the office. Networking, knowledge sharing, culture. And one thing that folks are not talking about is that enhanced communication is reducing mistakes. I've talked to a number of businesses and they're saying we've pulled people in more than our competitors, but one of the things we're noticing is we've reduced our mistakes. So in that front, I think there are activities that are done better in the office. On the flip side, I think there are activities that may be done better remotely. I mean, if you have to concentrate, if you're on the phone, from that standpoint, doing that in an open floor plan is probably challenged. What we do know is employment. So when I'm looking at employment, comparing it to pre-pandemic peaks, we're roughly 1.2 million jobs above where we were before the pandemic. Those job gains are concentrated in professional and business services, as well as transportation and utilities. Like I talked about, there are some areas that have deficits. Government, it's about 2% below pre-pandemic peak. Hospitality is about 6%, about 1 million jobs less today than it was 2 years ago. If you look at financial activities, professional and business services, and information, all of those areas are above pre-pandemic peaks. And one of the puzzle pieces that we can put in place for the thought around the need for office is that we have more jobs today than we did pre-pandemic in those 3 sectors that have the greatest correlation to the use of office. Those occupants, those tenants use the highest percent of office space per worker. So from that standpoint, we do have more jobs. Now we know there will be efficiency wrung out of that, but from the standpoint of jobs, we have them back. If we look at retail sales trends, we can see here that the demise, you're talking about the retail apocalypse? That's right. So we all talked about it. I had some banks that had some challenges with that. But the retail apocalypse, was oversold by our friends in the press. And you can see the growth in traditional bricks and mortar in green. Obviously, during the pandemic, we saw a contraction of almost 4%. But after that, we all got out, we all spent a lot of money, and from that standpoint, sales grew at 35%. And now we're beginning to kind of see it come back down, but leveling out right now at roughly 8%. When we look at e-commerce, from that standpoint, it's grown significantly over the last decade, almost at rates of double digits. And from that standpoint, when we were all sheltered in place, we all got on our computers and we, bought like there was no tomorrow. I think it is interesting right now, one of the benefits of the industry, and Stephanie kind of touched on it, is that whole conversation around the retail apocalypse, around what e-commerce was doing to decimate traditional bricks and mortar retail, caused a significant amount of lenders and developers to pare back the amount of space that was being built. So from that standpoint, we're benefiting from having low amounts of space built over the last decade in retail right now. We are seeing some more challenges. One of the things that we're actively looking at is mom and pop restaurants right now. It's my belief that they are the tip of the iceberg. When you think about inflation, the impacts of inflation, they're going to be hit hard by rising food costs, as we talk about. They're going to be hit hard as the consumer pulls back in an area of discretionary spending. And third, they don't have the significant amount of capital resources to kind of weather the storm. And fourth, they probably are having challenges, like most businesses, finding labor to reopen to pre-pandemic levels. So from that standpoint, I'm sad to say, but I see more mom and pop businesses closing right now. It's in restaurants, but we're also hearing about the stress in some other segments. But it's an issue we have to watch. We know there's still a lot of industrial space that's under construction today. So far, the market's done a very good job at absorbing it. We've heard, some early challenges around Amazon. I was in Dallas 4 weeks ago, and this was the #1 issue for the industrial developers. They were concerned that Dallas was potentially going to be overbuilt. Not seeing it yet, but the data shows that vacancy rates have come way down, And then as we look at the amount of construction as a percent of inventory, nationally we're building a whole lot more. So the risk is heightened in my view. I think air travel. Obviously, we've had a lot of full-service hotels that have had some challenging times, and from that standpoint, this represents the number of folks that are going through the TSA turnstiles. We know that airlines have pared back capacity, but I think some good news is that 2022 in blue, started off 5 to 10% below 2019 levels. But there have been times this year that we've hit 2019. So from that standpoint, we are seeing folks that are traveling. We have seen conditions pick up at some of those full-service hotels that had the greatest impact during the pandemic, as essentially they were almost fully shut. So again, some positive news on that front. I was asked to speak a little bit about Atlanta today. Certainly Stephanie did a much more in-depth job, but I'm going to talk a little bit about some of the trends. So this represents employment in the bars and then population growth in the line. And so you can see right now, we know that there is in-migration into Sunbelt markets, i.e. Atlanta. And from my view, that population growth creates somewhat of an insulating factor. Because in that essence, more people, more need for commercial real estate. Job growth has been, bounced back very strongly. As a matter of fact, it's the strongest that we've seen in the last 20 years last year. So from that standpoint, again, the expectation is that jobs will improve commercial real estate. Vacancy rates right now across the city, we're a lot like the nation. Multifamily and industrial doing well, retail also, and then the challenge is the office market right now. And what we know is that this number, probably needs to go up as there's a significant amount of sublease space on the market today. As far as construction is concerned, again, kind of mirroring what we're talking about in the nation right now, significant amounts of multifamily that are under construction in the pipeline, most of them geared toward the luxury space, in the time where rents are beginning to fall and occupancy is beginning to fall as well. So from that standpoint, it's my expectation that we will see more challenging dynamics in the upper end of multifamily. Industrial right now, we're continuing to lease it, but again, we're building a lot more of it. So areas that we're concerned about right now. So one of those challenges is the inability of lenders to accurately assess commercial real estate value. In my travels across the nation over the last several months, lenders have consistently sourced that as an issue. And from that standpoint, we know that the amount of transactions have pared back. We know also that there is the shift in cap rates, and from that standpoint, we are seeing some values beginning to decline. We look at consumer-related real estate. That's an area that we're watching pretty closely as we think that there's more stress in that. Talked about luxury multifamily. Office, the future impact of the office. I think we know that densification has gone on pretty significantly. At the same point, we know that larger firms are probably have a significant more probability to wring out efficiency in their space. It is easier if you're a behemoth and you've got 10 floors and you can give back a floor versus a smaller tenant who's got 4,000 square feet who's going to wring out 400 square feet. They're not going to do it. So I think that from that standpoint, those larger firms have a higher percentage of workers that travel. There is a better payback. They have the capability to make the investment. And so that's where you're going to see some of that efficiency wrung out. Now, the good news is I have a son at the University of Florida right now. He's studying finance. He has an internship here in town. And I said, how many days a week do you have to go to work? That's right. It's a loaded question. And he said, I got to go to work 2 days a week, Dad. I'm like, well, okay, we're starting. But he said, Dad, I asked if I could go to work all 5 days. And I said, wait a minute, you want to go to work more than they're requiring. I'm now in kind of parent mode, like what's going on? And he says, you know, Dad, I don't meet people sitting at home. So from that standpoint, I want to go to work. I want to go to work all 5 days because I can network. Maybe I did something right. For those office brokers, you're free to quote me on that. But I think, you know, there is some part of the generation that's coming out of school right now. My son's 19, so he's got a few years. They've got a few years to ruin him at the University of Florida. But I think, you know, from that standpoint, there is a group of folks coming out that want to be back in the office. And from that standpoint, they view it as part of the compensation. It's not actual cash, but the growth trajectory. They realize that the growth trajectory in the office is heightened versus being at home where it looks muted. And from that standpoint, I think that some of that group may go back. The other thing is it may encourage senior folks to go back as well. If you think about it, if they view part of their compensation as the proximity to senior folks, whether it's the dissemination of knowledge or going to meetings for networking, et cetera, if they value that, then in essence, you may not have to pay them top market rate. We will see. But I think from that standpoint, we will see more folks come back to the office. The other thing is, if we go through a period of economic slowdown, we're already beginning to see some businesses laying folks off. What's probably the top catalyst driver for being laid off? Invisibility. If you're at home, you may be invisible. You may make it. We've had some businesses say they may very well make the decision based on that. We'll see. So, anyways, I'm running short of time. Let me kind of walk through some of this. So I think right now there's an increased risk around net operating income, and the reason I say that, higher inflation may push up expenses faster than rents. How many of you are seeing double-digit rent growth right now? Just a few. How about double-digit growth property taxes? Insurance, that's right. How about utilities? Nationally, we know that utilities are up 16% over last year. And last but not least, labor, if you can find it. We have businesses telling us that all of those are up more than double digits. Secondly, if we have, we have labor challenges, there is a shortage. And from a capacity perspective, retailers are probably hard hit, restaurants from that standpoint. If they're not able to open to, pre-pandemic levels, there are probably going to be challenges with percent rent clauses. And then, last but not least, also, if those businesses have an inability to reopen, at some point they change their fixed costs. They contract, they close, et cetera. So we're watching this. Area we were watching, loans. This is just a sliver of the market, but what I can tell you is floating rate debt have all seen their debt service costs go up pretty significantly. And then we have a significant amount of maturing debt. From that standpoint, lenders are telling me that nobody is happy with the cost of debt right now. I've had lenders tell me that their debt yields were 11%, now they're thinking about moving it to 13. And I'm just thinking to myself, gosh, cap rates were nowhere near that. So we have lots and lots of situations of negative leverage. In essence, what's happening right now is most of them are going on bridge financing, and they're going to do a year, and they're going to say, where are rates in a year? I don't know, but if I'm a betting person, I don't think they're going to be going down. So from that standpoint, I think we're watching this area pretty closely. Looking at risk. So we have a number of non-bank lenders and some bank lenders who are offering 80, 85% LTV in a market that is showing value declining. Those two don't go together very well. I'll just say that. What we do know is some of these, no matter whether it's bank or non-bank, some of this debt may need to be refinanced in short order. Negative leverage. I hate to, it's like silent, sorry, I'm killing the, I'm gonna get kicked out for causing everyone to ruining this good meal, my apologies, but I think I'd rather tell you what's going on. We know that in an apartment market, lots and lots of negative leverage right now, lots of it. So from that standpoint, the industry is struggling with the increase in rates. There are some segments of the industry right now that are illiquid. You look at CRE CLO, you look at CMBS SASB, both those areas are illiquid right now, and that certainly is getting to the policymakers' attention. But we have negative leverage. Historically, cap rates have compressed pretty significantly over the last 20 years, which has created a lot of wealth in this business. This represents the spread between the 10-year Treasury and cap rates, and what you know is that the 10-year Treasury has moved up about 250 basis points since the beginning of the year. It's tailed off in the last couple of weeks, but from that standpoint, as this spread compresses, it's my view that the probability of cap rates going up increases. Real estate owners are not going to take significantly less premium for the same amount of risk. So from that standpoint, we are beginning to hear about those early transactions that are occurring. When was the last time that you heard about double-digit cap rates? That's right, long time. Just heard of a deal on the West Coast in a gateway market, Class A office building, 10.25. 10.25. That was down 37% from last year. So we're seeing that beginning to percolate. That's hopefully that's atypical, but certainly from that standpoint, we're beginning to see some of those results as we see cap rates move. This is an index done by Green Street Advisors, and I like it because it includes transactions plus appraisals. We don't have a lot of transactions to validate what cap rates are, but in this instance, Green Street is saying that that value in their index has come down to roughly pre-pandemic levels, about 13%. So not far, but it's coming down. If it continues to decline another 10%, we'll be back to levels in 2018. But again, that will be highly driven by the market, the property type, the tenants, et cetera. So a slippery slope. Fortunately, we're talking to a lot of brokers these days. And from this standpoint, they're telling us that apartment values are off roughly 8 to 20% across the nation right now. Not a lot, but enough. We see industrial down 15 to 30%, and part of the significant driver there is there's a little bit of dislocation in that the industry in that segment is willing to pay less for buildings encumbered with longer-term leases compared to buildings with short-term leases or vacant. Office space down down anywhere from 10 to 30%. Retail and hotels have not moved a significant amount, and that being because of issues with their valuation holding over from COVID. And then just like to kind of point out, it's my public service announcement to the lenders in the room, values are coming down. And from that standpoint, we know that there are a lot of 65, 75, 85% loan to value loans out there. From that standpoint, if value comes down, it's the world's best Christmas gift. You get to spend more time with your regulator. But I would say, on a serious note, we do know out of the GFC that borrowers who right-sized their debt were able to ride out that storm better than borrowers who borrowed every last dollar. I was a developer one time. I was definitely in that category. So I'd like to close, and then I'll take a few questions if I have time. So I think, the economy continues to remain pretty healthy. We have a very, very robust jobs market. Even with the layoffs that have been mentioned in the last week, we still continue to see pretty solid economic activity, though it's moderating, pardon me. We see heightened inflation levels are impacting the consumer. They're also going to impact your property operating cost. From that standpoint, it could erode NOI, which could very well impact value. The increasing 10-year Treasury putting upward pressure on both debt costs and cap rates. And from that standpoint, I think that decreasing NOI and increasing cap rates could very well slow price growth, or in essence, turn it negative. I do think that there are opportunities. As we see the market reset, there are going to be a significant number of firms that need to fairly understand what value is, and from that standpoint, is there opportunities for repositioning, recapitalization, et cetera. So from that standpoint, while there are dark clouds swirling, I think there is some silver lining. The other thing I would say is that as the Fed moves, we've come out of an accommodative stance on monetary policy and moved to one that's very close or closer to moderately restrictive. If the FOMC decides to slow those policy moves, then the market, we've reduced uncertainty, and the market will be able to forecast interest rates, cap rates, et cetera, to a better degree, more accuracy, and I think that will allow some firms to get back to a greater level of business. With that, I will take questions, if there are any. Yes, please.
Okay, so I'd like for you to maybe predict inflation going forward. You're trying to get to 2%, right? You got energy prices, Ukraine, Saudi Arabia. You've got the strategic, I'm loud enough, that's okay. You've got the strategic oil reserve been depleted by about 50%. They can't keep doing that. So when they stop that, gas prices are going to go up. So where do you see it going from there?
Talking about the rate of inflation?
Yes.
Well, spent the day with 2,000 bankers yesterday.
That'd be fun.
Yeah. It was even more dire. As a regulator, as a bank safety person, I've got to be a little bit more harsh. But I think we took their temperature on what they feel like inflation was going to be at the end of 2023. And about 2/3 of them, in their opinion, thought that inflation would be 5 to 7%. Now the FOMC is signaling, and I think it's that they believe that inflation will be high 3s next year.
So when you're setting rates, like it's 3.75 now, are you going to be at 5? Where's it going to be?
You're asking me about rates. Can't touch that. I can tell you that the FOMC thinks that Fed funds will be in the high 4s next year, at the end of next year. Yeah. Yes, sir.
As interest rates increase,
Mm-hmm.
and there's obviously going to be a global impact with other countries that are doing foreign direct investment in the U.S.
Mm-hmm.
As our rates continue to increase, how is that going to, in your opinion, impact foreign investment, foreign economies who want to invest in the U.S., but there's that blockade as we continue to raise it?
Absolutely. No, I've talked to Japanese and Korean investors in the last couple of weeks, and both of them have essentially gone to the sidelines because of the devaluation in their currency and the increased valuation in ours. They're still bullish on the United States, but in their view, they're waiting to see an ebb in the kind of value of the U.S. dollar before they come back. I mean, a couple firms have billions of dollars in assets here, and from that standpoint, they're not going anywhere. But I think that they're waiting for an ebb in the dollar to come back in to be active in the acquisition market. The other thing it does is that it makes, as the dollar heightens, increases in value, makes our goods less competitive overseas, which then puts more pressure on jobs. Yes, sir.
You guys analyze what will the effect of all the interest rates on debt, on the government debt will do?
So we talk to, we say a fair amount on that statement. Certainly you've seen former Chair Yellen, Chair Bernanke, even our current Chair Jay Powell say that, we're concerned about the amount of fiscal spending and the debt. Certainly with the changes in buyers right now, if you think about, the Fed is obviously moving to quantitative tightening, and we're selling some of our assets. The Chinese are selling some of their assets to defend their currency. The Japanese are saying, currency's heightened, we don't want to invest. So the market still continues to function. It's still got liquidity in it, but certainly we're looking at, making sure that there's liquidity in the marketplace so that it continues to efficiently function, whether that's treasuries, whether it's bank lending, et cetera. Anybody else, or stump the regulator done? Yes, sir.
Given interest rates and unemployment are generally inversely related with Phillipsburg, do you see the panacea for inflation to be immigration? And you're starting to see corporate layoffs and softening of the jobs market. Is that how to get inflation under control?
Obviously, that is a byproduct of increasing rates. And so from that standpoint, I think Chair Powell is articulating definitely a period of slower growth where we will go through some pain points. So I do expect there to be, some more of those challenges developing.